edition video solution walkthrough for exercises 16, 23, and 24. The textbook authors of this amazing, of this amazing accounting textbook are Don Kiso, Jerry Weingart, and Terry Warfield. The questions used in this presentation are copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved for educational purposes only. This video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. The opinions within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook, Wiley, or any employers or related entities of Bennett Tchaikovsky. Okay, so now that I'm done talking about myself in the third person, let's go have some fun. Okay, so we're still doing earnings per share. So let's take a look at our first question. So over here on June 1st, 2018, Andre Company and Agassi Company merged to form Lancaster, Inc. A total of 800,000 shares were issued to complete a merger. The new corporation reports on a calendar year basis. So we're going to assume that's from January 1st or December 31st. On April 1st, 2020, the company issued an additional 400,000 shares of stock, all for cash. All 1.2 million shares were outstanding on December 31st, 2020. Now, we're then going through over here and talking about some convertible bonds, and then we're looking over here at this last part over here. So let's do the first things first, which is doing basic earnings per share. We'll determine if this part over here is dilutive, but let's first figure out the number of shares to be used for calculating basic earnings per share. Okay, so basic EPS. So when we're looking at this for 2020, the 800,000 shares were outstanding for the full year. Okay, so this 800,000 was basically outstanding from 1/1/20 to 12/31/20. So I'm really effectively multiplying this value here by 12/12. So this is just going to be 800,000. Now, the company issued an additional 400,000 shares of stock, all for cash, and this was on April 1st. So no fooling here. So this is 400,000 shares. But these 400,000 shares are not the same as these 800,000, as these were only outstanding for 9/12, right? Count it out on your fingers. April, May, June, July, August, September, October, November, December. So 9/12. So in terms of, right, so this over here, I'm multiplying this times 9 divided by 12, or 300,000 shares, right? So my total, right? So the first part over here, in terms of what I'm being asked for, the number of shares to be used for calculating basic earnings per share is going to be 1.1 million. Okay. Now, this next one over here is that, now what about diluted earnings per share? Well, what we need to figure out first is that, is this thing actually diluted? Now we're going to assume that it is, but we'll do something in the very end to make sure that we're on the right track. So we issued $600,000 of 20-year 8% convertible bonds at par on July 1st, 2020. Each $1,000 bond converts to 40 shares of common stock at any interest date. None of the bonds have been converted to date. Okay, so the first thing we got to figure out here is, how many shares does this convert to? Well, if I have my total, if my total issuance was $600,000, that's how much cash I got, and the amount of each bond, basically I've got 1,000. Each bond is at $1,000, okay? So what that means is the number of bonds that I sold. So I've got 1,000 bonds and I sold those for a total of 600,000. That means I must have had 600 bonds sold, okay? So I've got my 600 bonds sold. These 600 bonds sold are going to convert. So each $1,000 bond converts to 40 shares of common stock at any interest date. Okay, so right over here, shares per bond. So my total shares being issued will be 24,000 shares, right? Now, what makes this a little, so I want to first figure out what are the total number of shares that are going to be issued. The next thing I have to think about though, right, is when I'm putting this here I'm being asked for diluted earnings per share. The challenge is with the diluted earnings per share, right? What exactly is going to be my diluted earnings per share? It's going to be the same two that are up here, but then for this 24,000 shares, right? This is going to be from 7/1/20 to 12/31/20, or for 6 months. So over here, I've got 12,000 shares. So on a fully diluted basis, right, this over here is going to be the number of shares I'm going to be using over here for the fully diluted is going to be 1,112,000 shares. Remember, you first figure out how the bonds are going to convert. Then we have to ask the same question. How long were these outstanding for during the full period, right? That's what we're trying to go through and figure out. Okay. Now, those are the diluted earnings per share. Now we need to figure out what are the earnings figures that we're going to be using for basic earnings per share. Well, for the basic earnings per share, let's see here, is preparing its annual report. The annual report will show earnings per share figures based on a reported after-tax net income of 1,540,000. Okay, so for basic EPS, it's going to be 1,540,000. This is the numerator or the earnings figures, right? This is my numerator. Now, when it comes to diluted, right, what's happening here is that we're going through and assuming that these guys converted, right? If these bonds here converted into the shares, what does that mean? That means I don't have to pay interest. So let's figure out what that interest is going to be. Well, I've got 600,000 in total bonds, right? The interest rate on these bonds were 8%, right? Whenever you see a rate, it is always going to be an annual rate, okay? So this is my annual interest, right? But for these bonds in particular, like what's the challenge? Well, I didn't have this interest outstanding during the entire year. The bonds were issued on July 1st. So similar over here to the 6/12, I need to multiply by this by 6/12, or 7/1 to 12/31. And this is going to be giving me a total interest amount of $24,000. So I need to add back this amount. Now, one of the challenges is here with this 1,540,000 is this is after tax. This here is an amount is pre-tax. So I need to add back this dollar amount. So what I'm going to do over here is I have to say, well, what is the tax rate? So right over here, I've got 1,540,000. And I need to add back interest net of tax. Okay, so this is basically going to be 24,000 times 0.8, or 19,200. So 24,000 minus 24,000 times 0.2, this is going to give me 19,200. Okay. So when I add these two numbers up together, I get 1,559,200. But what I want to do though, is the thing that I'm most fearful of is it truly dilutive? Let's find out. My basic EPS calculation is going to be 1,540,000 divided by my basic earnings per share of 1.1 million. So this earnings per share over here is going to be $1.40. If I'm doing the fully diluted calculation, right over here, I got 1,559,200. Remember, I had to add back this amount. Because I'm assuming it's converted, I wouldn't have to pay that interest. Because this is net income after tax, I have to add this number back after tax, or basically with those taxes taken out. So over here, I'm going to be dividing this by my diluted my fully diluted, which is 1,112,000. I get this over here, and my value is interesting. This is slightly higher. I'm going to pause momentarily. I'm glad that I went through and did that. And the reason why is that when you're going through and showing earnings per share, this number is technically higher, meaning that the bond we're anti-dilutive, right? What that means is that if the earnings per share of dilutive is actually higher than basic, I only show the basic. So because of this, we're not going to be showing the fully diluted earnings per share. We would just show basic earnings per share. We would say basic and fully diluted earnings per share. There would be a disclosure in the financial statements talking about that you would discuss the bonds that were being converted, and you would say that they are not included in the earnings per share calculation because they are anti-dilutive. So that's what we would go through and do. They were just asking us, they're not asking us to display it, but they're asking us just to go through and to calculate it. This is why I actually love this textbook, because it gets into things like this. Certain things about it I love, and other things, well, talk about the $10 par value per share later. Okay. Now, exercise 1624. The Simon Corporation issued 10-year, $5 million par, 7% callable convertible subordinated debentures on January 2nd, 2020. The bonds have a par value of $1,000 with interest payable annually. The current conversion ratio is 14:1, and in 2 years, it will increase to 18:1. At the date of issue, the bonds were sold at 98. Bond discount is amortized on a straight line basis. Simon's effective tax rate was 20%. Net income in 2020 was 9.5 million, and the company had 2 million shares outstanding during the entire year. So it's asking us over here to compute both basic and diluted earnings per share. Let's do the easy one first. So basic EPS is going to be my net income divided by my weighted average shares outstanding. So right over here, when I look at my net income is 9.5 million. Okay, my weighted average shares outstanding are 2 million. So what I need to go through and do now, so this is an important number to calculate because this is my baseline. So my basic earnings per share is going to be $4.75. Now what I need to go through and do is to do two things. The first thing I need to do is to figure out is if these bonds converted, right, how many shares would I be adding down here? Now, one of the things that I did is when I was looking at this, my gut instinct was saying, hey, Bennett, look at 14:1, but that was wrong. We want to look at the most dilutive, basically the most dilutive conversion ratio, or 18:1. So let's figure out first the number of shares that are going to be issued. So we have 5 million of total bonds. Total raise was 5 million. Okay, and the bonds have a par was 1,000. So the number of bonds that were issued are going to be 5,000 bonds issued. Now, we're going to go ahead and use the most dilutive. So we're going to use the 18-to-1, the conversion ratio. Even though it's 14-to-1, we want to use the most dilutive. 18 is more dilutive than 14. So right over here, okay. So right here, this is going to give me a total of 90,000 shares. Now, unlike some of the other examples that I just went through and looked at, right, these bonds, right over here, right, I don't have to multiply this by any type of fraction. Why? Because these were issued on January 2nd of 2020. This amount over here was the full amount for the year. So for my fully diluted EPS, on my denominator, I'm going to have weighted average shares plus my conversion, right? So this is going to be 2 million plus my conversion, or 90,000 shares. Okay. Once we have this in my numerator, what I'm going to have to do is I'm going to have to take my net income plus the interest that was avoided by the conversion. And I want to make sure that I'm going through and doing that net of tax. So this is a little bit funky, right? Because we've got a discount and we've got some other things going on, but we're going to figure this out right now. So let's take a look what happened when this bond was issued for 98 on 1/2/20. Well, when the bond was issued at 98, that basically means I'm getting 98% of this bond's face value in cash. So over here, I've got cash of $4.9 million, right? My bond payable is always going to be at face value, because that's ultimately what I'm going to have to pay once the bond matures. The difference over here, because I'm receiving less, this is going to be a discount on bonds payable. My discount on bonds payable is going to be $100,000. Okay, so that's what we're going through and doing here. So this is really important. And the reason is when we pay interest, right, on the bond, we're going to have to amortize this discount on bonds payable to my interest expense. So if you need a review, right, whenever we have a bond at a discount, this is always going to be the journal entry that we're going to be using. Over here on 12/31/20, when we pay the interest, if I'm paying interest on a bond that was issued at a discount, I'm going to debit interest expense. Okay, I'm going to credit cash for the amount of interest that I'm paying, and then I'm going to credit discount on bonds payable. Why? I need this number to ultimately get to zero so that when the bond matures in 10 years, this discount on bonds payable is zero. I pay the full $5 million off. So I have to amortize the discount on bonds payable. Okay. So the amount of cash I'm going to go through and pay is that this is an annual rate. So this is 7%. So the amount of cash that I'm paying is going to be 5 million times 7%, or 350,000. This is a 10-year bond. So I'm going to amortize the discount on bonds payable. It tells me right over here that the bond is going to be, the bond discount is amortized on a straight line basis. So I'm going to take this 100,000. I'm going to divide this by the number of times I'm paying interest. The bond pays interest annually, right? So it's every year. So it's 10 years. So there's a total of 10 payments. So right over here, I divide this by 10. When we're going through and using straight line amortization, the interest expense is always the plug or the balancing amount. So my interest expense for the year is $360,000. Now, at $360,000, I can't compare this because this is a pre-tax amount to this 9.5 million. So what I'm going to do is I'm going to take my interest expense pre-tax of 360,000. I'm then going to multiply this by my tax rate. My tax rate here was 20%. Okay, so right over here, basically my interest expense net of tax is going to be 360 minus 72 or 288,000. Okay, so now I have the numbers I need to do the calculation for this problem. So because I don't have to pay this interest if the bond's converted, that's why I've given the 90,000. What I'm going to do here is I'm going to say, okay, 9.5 million plus 288,000. So when I add these up, I'm going to get 9.5 million plus 288. I'm going to divide this by 2 million plus the 90,000, right? So when I divide these through, I'm going to be getting 4.68. Because that 4.68 is less than the basic earnings per share, the bond issuance or the bond intro, the bond conversion is dilutive, right? It's not anti-dilutive as we saw that was up here. If it's anti-dilutive, I just show the basic amount. I would make a disclosure in the back of my financial statements that the security was anti-dilutive, therefore it's not being included. But in this case right here, it is in fact dilutive. Okay, so that's a schedule to compute both basic and diluted earnings per share. That's how the schedule would differ if the security was convertible preferred stock. Okay, so when we're computing net income, right, basically, or when we're computing basic EPS, what's the formula? It is net income minus preferred, basically minus preferred dividends, right? So over here, right, how would the schedule differ? Well, the first thing is for basic earnings per share, I would have to go through and subtract those preferred dividends, right? However, if the preferred stock converted, then what would happen? Well, I wouldn't subtract any preferred dividends for fully diluted. Why? Because if those preferred shares converted, then I wouldn't have any preferred dividends. Everything would be common. So I would show net income minus nothing divided by the weighted average common shares plus the preferred shares as converted. So that's how the schedule would differ if something over here was convertible preferred stock. So again, I want to thank you for joining me here today. That was exercises 1623 and 1624. I'm slowly getting through all of this. This has by far been probably one of the biggest learning experiences for me, just because this is probably one of the most challenging parts, but it is all coming back. I'm going to have fun doing more videos for you in the very near future. Again, if there's anything I can do for you in terms of creating a video that you'd like to see from this textbook, send me a message in the comments. Please don't forget to like and subscribe. And I look forward to seeing you on the next video. Have a great day.